Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, on a week when the stock market lost about 4%, the dollar dropped out of the 90 cents region and our banks copped a walloping, Shane Oliver will put this negativity into investing perspective. IG Markets' Chris Weston will look at the market mayhem that might follow if our Scottish buddies decide to go it alone. The Australian newspaper's Damon Kitney will preview the Deal magazine tomorrow, which looks at our top 500 private companies, particularly that of Anthony Pratt's. Busy, of course. FN Arena's Rudy Philippik-Van Dyke will rate the banks after a bad week. Should we flick them or chase them? And Kate Thorley will look at the first day of trading for future generation investment funds. Stay with us for the next hour and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@switzer.com.au. And you can follow me on Twitter and the handle is @PeterSwitzer. But first, it's been a controversial week with worrying Chinese data, a dropping dollar, the stock market down about 4%, and concerns over the Scottish independence votes and what the Fed might do in the USA. So should we be worried or see this as a buying opportunity? Shane Oliver of AMP will allay our fears or scare the pants off us. Shane, what are you going to do?
What am I going to do? Well, I might have given you a bum steer then, because the 4% I was talking about in the share market was from the high, which was about 50.
So you've done some calculations. I was right when I said 2 before.
Well, for the week, depending on which way you're looking at.
Ladies and gentlemen, I said 2, he said 4. Was I going to trust me? Well, generally I trust Shane, but it's good they've got one over this year.
I always think in terms of highs to lows.
Yeah.
But,
so 2% is not bad, but still, a lot of people have contacted me and said, yeah, Switz, what's going on? You're not focusing this on the show. So tonight we're going to focus on what's going on and should we be scared. Shane, take it away.
I don't think we should be scared.
Good, thank you.
I think this is just another little correction. Yeah. The reality is that the Fed is getting closer to raising interest rates, and every time there's a run-up to the Fed meeting, investors get nervous, so that's a global backdrop. You've also got the Chinese data, so that set us up for a bad start. The Chinese don't know anything about the weekend. I mean, they should respect weekends. So 3:30 Saturday afternoon, I'm down there at the water, and lo and behold, up pops the data. I think they've made a mistake. 6.9 should have been 8.9 or something. But
see, the Chinese know that you are actually waiting for the data.
I think they do. I think they
do. Let's just ruin Shane's weekend. I think Craig James's weekend was ruined as well, because he sent it to me and he ruined my weekend as well.
No, I didn't want to send it to too many people. I did a tweet on it, but I didn't want to blast it too much out there. Right, but it was kind of disappointing to see those numbers.
But you've had a week to look at them. Was there any silver lining in this dark cloud?
Well, the only silver lining in all of this sort of stuff is, well, firstly, the Chinese data has been running hot and cold a bit lately. It can tend to be a bit volatile. But the silver lining, of course, is that I think the Chinese authorities will say, well, we don't want it to fall much below 7%, if at all. And we did see yesterday news that the Chinese authorities look to be stepping up stimulus in terms of pumping money into the banks. So the 5 major banks got 500 billion renminbi between them, which is equivalent to a cut in their reserve required ratio of about 0.5%. So that's a move in the right direction. So yes, there are concerning data coming out of China, but I think given that the slowdown was due to the authorities tightening in the first place, I think they have the authority and the ability to sort of stabilise growth coming back. Then the other thing, of course, has been the Aussie dollar. And foreigners, I think, own about 30-40% of our share market. And typically, when the Aussie dollar is falling, they tend to shut up shop, go home, just stay away, because they're fearful that they'll get hit by a double whammy as the value of their investment falls. So it's not surprising to see the market coming down when the Aussie dollar's going down.
Particularly the banks, because they've been great investments for them.
That's precisely right. So the banks got hit by a sort of a yield-type concern, with the Fed maybe moving towards rate hikes, and of course the fall in the Aussie dollar. But that's another aspect, the silver lining of the cloud here, that as the Aussie dollar comes down, it will help, I think, remove a big problem for the Australian economy, which has been the Aussie dollar has been too high. So the Reserve Bank got interest rates to where they should be. They got them down, but the Aussie dollar stayed too high, partly because of the Fed and other things like that. Now, with it coming down, that, I think, just gives me more confidence that we're going to see a rebalancing in the economy, because all those sectors which have lagged so far, like manufacturing, tourism, higher education, sectors that have to compete internationally. Even miners get a benefit out of this.
Yeah.
They'll be given a bit of a boost. And each 10% fall in the Aussie dollar boosts earnings by about 3%. So
a 10% fall in Aussie dollar
boosts earnings by about 3%.
Okay.
So if this thing goes another 5 cents, we'll be off about 10 cents from the more recent high, which would be worth about 3% boost to share market earnings, which I think is quite a good thing.
And Shane, what the foreigners that get out, when they think the currencies hit bottom, do they come back?
Well, invariably they do.
Oh, I mean,
it often takes a while, but typically what happens is the market's coming down as the Aussie dollar's falling. Foreigners stay away, or in some cases sell. Then, of course, what happens is time goes by, the analysts start revising up their growth forecasts because of the lower Australian dollar.
Yeah.
Everyone starts to notice that, and the market starts going back up again.
So this is going to be a buying opportunity for locals, in a sense that they'll
probably recognise it before the foreigners do, and then the foreigners will come in a bit later.
Well, I checked. I think ANZ's down about 6% for the week.
That's right.
It's a big drop.
They have had a big drop.
So, and I think if the banks drop 6 or 10%, I'd be happy to buy them.
Yeah, because the dividend that they're paying hasn't changed. Their earnings and outlook hasn't changed.
And you're saying that the economy's going to get better for them.
Well, I think it gradually will.
Yeah.
We're looking at a more balanced economy here going into next year, not the doom and gloom that we hear a lot about from your associates in the media at the moment.
The scumbags in the media.
Whatever happens, it's a total disaster.
Yeah, but there's also the short-term traders respond that way, don't they? Like if I'm a broker advising my clients, I don't want them to lose any money, so I might be saying to them, get out of the banks now. Yeah. But in 4 or 5 months' time, I say, now they're good value, get back in. But if I'm a self-managed super fund investor, in a sense, if CBA was 80-something and drops down to 72, 73, well, it's a good buy for me.
It probably is. You also got to
very careful way for probably.
Yeah. Well, there's always this thing. You don't know whether it's going to fall another couple of percent or something. Yeah. That's why I say probably. Yeah. But the old rule is dollar cost averaging. You start as it comes down. You sort of average in because you don't know the precise bottom.
Correct.
Yeah. I mean, the other thing with all of this is that many investors might find it hard to time this. If you sort of think to yourself, no, they're coming down, momentum's against me, maybe I should sell. The trouble is, by the time you've done all your selling and what have you, it'll be going back up the other way.
Yeah.
So you won't have gained anything. I think the better approach is to average in through this period of softness. Also, bear in mind here, this is September. September is historically the weakest month of the year in the US share market, and historically for Australia it's October. So we're going through the tail end of the sell in May, go away period, but the full saying is come back on St Leger's Day. Sell in May, go away, come back on St Leger's Day, which is late September. That's a UK-based saying, but late September. You should be looking to buy in through this period of seasonal weakness because I think we'll see a good rally into year end.
Love that. Now let's go to Scotland. Are you worried about those wily old Scots?
Not really.
Huh?
I mean,
you think they'll vote yet? No.
Well, yeah, that's one point. A lot of undecideds there.
Yeah.
Which way will the undecideds go in this situation? They'll probably go in the less risky scenario, which is to vote no. If they have a strong sort of emotional view that they should vote yes, they probably would have already decided that. They wouldn't be registering as undecideds in all the surveys. So my inclination is to think that the no vote will have it, not the ayes on this one. Am I worried about it? It's mainly a concern for Spain and Catalonia. I don't particularly care. I do care about the UK, but it's a small part of the world these days. When you think about global regions, you think about Europe, you think about the US, you think about China. The UK is sort of off on its own there, relatively minor in the first place. So if they vote yes, it will be bad for UK assets. There'll be uncertainty about how to divide up the national debt, whether there'll be a monetary union or not. All these sorts of issues will come into it as you get through most divorces. So that would be bad for the pound, bad for British assets, particularly bad for Scottish assets.
Yeah. The
Scottish banks will worry as to whether they're going to get the protection from the Bank of England. Some of them might relocate to London, so a real issue around that.
But then they'd be accused of being traitors and lose their base in Scotland.
They may, a real issue for them. But the bigger issue globally, I think, is if there's a strong yes vote, it might embolden the Catalonians to press their claim to independence from Spain, which could then reopen concerns about Spain. But as I said, I think at the end of the day, fingers crossed, we'll wake up tomorrow morning or whenever it is, early morning, we'll find out the exit polls, and I think it'll be a no.
Okay, so you're not worried about China?
I'd probably have China up. It's a higher risk than Scotland is. Scotland's sort of way down here.
Yeah.
China is probably a bigger one, and obviously the one to worry about there is the falling property market.
Yeah, but isn't it interesting that no one came out and said, hey, we can't trust Chinese data anyway? So they've admitted to a slow growth period, and no one said, oh, I can't trust that data. If it was a great figure, I can't trust Chinese data.
Right. Whenever I tweet these numbers, if it's a good number, everyone's saying you can't trust Chinese data. You're precisely right, but I got none of that on the weekend when I tweeted the bad number.
Yeah, experts. Fed, the decision by the Fed, good or a bad idea?
Good. I think the Fed is doing precisely the right thing. Their economy is on the mend, so rightfully they should be thinking about when they will start to take away some of the stimulus. But by the same token, you've got 12% of the labour force either unemployed or underutilised, and in that environment, it makes sense that they not rush into raising rates. What were the inflation figures this morning? 1.7%.
Yeah.
Wages growth, 2.1%. Why would you be rushing into a rate hike in this context? The doom and gloom that came with quantitative easing about hyperinflation just proved to be a load of nonsense. It hasn't happened.
It's funny those people who are arguing it haven't come out and say, hey, I'm sorry, I was wrong.
No, they've all just disappeared. They just moved on to the next thing to worry about and the next disaster.
Okay, so do you think that she's saying to herself, Janet Yellen, I'm not going to do this until the economy is so strong, so even if the stock market overreacts, as it might, it won't matter because the economy is so strong?
Well, when it comes, that's what will happen. I think probably, I've been saying June quarter next year. I'm sort of inclined to June, so that's still a fair way off.
It was March, but now I think it's going to be June.
Yeah, history tells us when in the run-up to these things you can have a few wobbles. Look what happened last year when Bernanke mentioned the word taper and tapering in May. You got a bit of a fall, 5 to 10% fall in share markets in the middle of last year. So you could have a little wobble along the way. But history tells us that after the initial wobble associated with the first rate hike, the market then regathers its composure and says, well, rates are only going up because the economy is stronger and profits are stronger. And in any case, rates are still coming from a low level. So it's only when interest rates get to onerous levels, you've got short rates above long-term rates, that's called an inverted yield curve, or you've got short-term interest rates above some concept of normal or neutral. And we're going to be a long way from that for the next few years.
And Shane, you aren't paid just to be optimistic. If you were pessimistic, you would just be pessimistic.
Well, then I'd be more pessimistic. Then I'd be pessimistic. I mean, but I think the reality is here that things still look okay. Valuations to me look reasonable. Not as cheap as they were a couple of years back, but look reasonable. The cyclical environment is still one of global recovery, good for profits. Monetary environment still okay.
Well, I'm happy to have you on the show, mate. You're just reinforcing my positive view. Great to see you, Shane.
Thanks, Peter.
So after the break, as Scotland votes, the question is, what happens if they say yes? Chris Weston from IG Markets. Up on that next.